Good afternoon. My name is Mario Becker. I'm the CEO and founder of Das Family Office, a Singapore-based multi-family office and fund management company. We're licensed by the MAS with a CMS license. In the following video, I'm summarizing the events of the first quarter of 2022, and I hope you're finding it useful. The expectations for 2022 were actually modest, since 2021 was such a great year, especially for global equities. It wasn't such a great year for global bonds, but it was a tremendously good year for global equities. But what we could witness, or what we had to witness in the last several weeks, is something we wouldn't have imagined in our wildest dreams. Putin's invasion of Ukraine overshadows all other events since the 24th of February. Apart from the terrible human suffering in Ukraine, and obviously also the dead Russian soldiers, the war is worsening the inflation picture, which already started to change the discussion in 2021 because global supply chains were sputtering. The commodity price situation, specifically also in the energy, but also the agricultural commodities, but also pretty much everything, because Russia is a big exporter, so is Ukraine, has really changed the global commodity dynamics, and prices have skyrocketed. Together with that, we've seen a massive inflation. At the same time, there seems to be a new Iron Curtain evolving between the Western world and Russia and potentially China. But let's hope there's a way back, because the world should really be concerned with global warmings and matters that are really of urgency, and not look at fighting wars as people used to do it in the last century. Given the higher prices, the Fed and all other global central banks have basically changed their direction, because higher interest rates are needed to counter higher prices. The term transitory inflation, which the Fed used last year, has practically disappeared. And on a certain level, it appears that the Fed may even be panicky and wants to raise interest rates quickly. In March, they raised the Fed fund rates from 0.25 to 0.5%, and expectations are that they will raise Fed funds rate all the way to 2.5% and maybe even higher. Just now we heard one of the big banks talking about potentially 4%. That would be a very big number, a number we haven't seen in years. US government bonds have already anticipated this development to a large degree. We're probably not done yet, but the adjustment has already been material. Short-term interest rates have moved from about 0 to now about 2.5%. And medium-term interest rates in the US are between 2.5 and 3%. That indicates that in the medium term, over 5 to 10 years and longer, markets are expecting a moderation of inflation. Otherwise, we wouldn't see such interest rates in the long run. There's a small inversion between 5 and 10 years, which means 5-year interest rates are a bit higher than 10-year rates, which typically points to recession risk. Because in the past, whenever we could witness forms of inversions of the yield curve, that often meant a recession risk. Some people argue that since the Fed has been buying so many government bonds, the current interest rates are not fully reflective of the real prices, and are cautioning that this may not actually really be an inversion, but we're monitoring it. The European Central Bank has also started changing its tune. They're now also talking about reducing government bond purchases and potentially raising interest rates in the second half of the year. So there's a good chance that in Europe we will see an end to the project of negative interest rates, which has been criticized many times, and I think the bulk of Europe, most of the European investors would be happy to see that experiment being ended. In as much as US interest rates have anticipated central bank changes, the same has happened in Europe. German government bonds, the so-called Bunds, have now also moved above 0 across the curve, which is something we haven't seen in years. At the same time, 0% for 2-year bonds and 0.7 for 30-year bonds is not really inflation adjustment. So we'd caution our investors, don't actually recommend looking at these bonds. because there's potentially much more downside risk. Since 2021 was already a challenging year for bonds, unfortunately 2022, it's getting even worse. The beginning of 2022 has been the worst bond year since the early 80s. As a reference, the Bloomberg Barclays Global Aggregate Bond Index has lost more than 10% since peaking in 2020. That obviously, unfortunately, had a negative impact on our safety building blocks, which are typically investment-grade bonds or government bonds, and depending on their maturity, they've lost between 1% and 11%. 1% for short-duration bonds, 11% for the longer-duration bonds. Equities had a very good year last year, but they've also started 2022 on a negative note, although we could argue that they're doing a little bit better than bonds, depending on the equity segment. As a reference, also the 60-40 reference portfolios between stocks and bonds, that means 60% stocks, 40% bonds. This portfolio is typically used by institutional investors and asset allocators, and we're also using it for 7 to 10 year investment time horizons. This portfolio is also down for the year. It's down about 4%. This happens very rarely, and it shows how challenging this year has proven to be so far. Naturally, given this context, given the development of stocks and bonds, the clients of this family office also had a disappointing quarter. There's no denying that. But I'm very proud of them because they can keep their emotions in check. They've been reaching out to us. We've been discussing the market, but nobody really pushed the panic button. That makes me very happy because panic is not a solution, not ever. And our concept of fair horizons, which means we're building an asset allocation based on investors' cash flow needs and preferences, has worked very well and continues to work very well because this is simply the most effective way to build a good portfolio, even if there are some disappointing quarters such as this one. Now let's talk about the development of the safety components and the fair horizons purple to green. These are typically the investments of more conservative investors and clients that are looking at shorter to medium-term asset allocations, because safety is of a bigger concern than returns. Rising interest rates, as we mentioned, they're poison for government bonds and investment-grade bonds. That is why, unfortunately, all our safety building components suffered losses between 1 and 11%. There's no denying it. Only inflation-linked building blocks in euro denomination have done a little bit better and have shown slightly positive returns. In general, the longer the duration of a bond, the higher the loss if interest rates rise. And given the challenges of rising interest rates for investment-grade bonds, we actually highlight to all our clients that they need to add certain equity allocations and potentially also commodity allocations to their fixed income allocations. Otherwise, they cannot maintain purchasing power in times of elevated inflation. A good solution are also the portfolio building blocks, Portfolio 2 and Portfolio 3. These are our discretionary building blocks which we're using together with dimensional fund advisors, which fit perfectly in the current environment because they always have about 20 to 30% allocation to equities. At the same time, the equity selection has a value tilt, which typically also works quite well in times of rising inflation and rising interest rates. And that's the reason why we're highlighting these to our clients, because we're very comfortable, the clients who own it are happy, and we want to show it to more people. Now let's look at the development of the return components and the fair horizons yellow to red. These are typically investments where high returns are the main objectives, and asset allocations with time horizons of 7 to 10 and even more years. And return building blocks or investment components tend to be equity investment components. 2022 is not only difficult for bond investors, but it's also difficult for equity investors. But depending on the kind of equity solution somebody chose, the outcome is very, very different. For example, if you stuck with the building blocks 01 to 05 or R4 and R5, which represent an investment in broad-based equity indices such as the MSCI World, FTSE All World, or MSCI World Smaller Companies, which more or less contain all global companies without any filter, without any focus, without any concentration. And they lost only about 4%. Given the context, given the situation in Ukraine, this is actually quite remarkable. What's the reason for that? These indices include pretty much all the stocks listed on global exchanges, which means they also contain shares of companies that are considered problematic or not sustainable, especially in times where ESG investing is very, very important. So here we talk about companies like mining companies, oil producers, or defense companies, which are typically not chosen by our quality managers and are typically not included in the so-called sustainable indices. At the same time, banks are profiting from higher interest rates, and banks are generally also not included in our quality managers because they don't have sustainable earning profiles. The profitability is often not sufficient, and it's also quite difficult to understand bank balance sheets, which is why the bulk of our quality managers shun banking stocks. But yeah, they've had a terrific quarter, and it's helped these broad-based indices to only be down about 4%, which is actually very good. And as we like indexing, we're not only proponents of quality stock selections, but also of broad-based index investment. This has turned out to be very, very good in the first quarter of this year. At the same time, like I mentioned repeatedly, quality stocks, companies that have great earnings profiles, high profitability, and low indebtedness, on a certain level, they've been bought aggressively in preceding years, so potentially some of them were quite expensive at the end of the year 2021, which is why they had a really, really bad quarter in the first quarter. I mean, many of them were down about 10%, which is more than the 4% of the global indices. And some of them, especially the ones that invest in smaller companies, they were down almost 20%. This was indeed a bit of a shocker because the index for small company stocks was down only about 4%, which makes you wonder how can these fantastic managers deviate so much. And we've extensively spoken to our fund management partners, and the answer is typically that they don't include the oil and the mining sectors, that they don't include banks, and at the same time the stocks were probably a bit expensive. And in times of rising interest rates, these quality stocks are not as sought after as the so-called value stocks, which is why we've seen these results as they happened. It's not really a problem from my perspective. Of course, it's disappointing, but all our analysis and all the long-term developments prove that quality earning companies are outperforming broad indices, and there's no reason to think that this is going to change in future. I mean, like if you have a chance of now founding an oil company or founding Microsoft or some other successful software company with high profitability, you would probably start the software company and don't start the mining company. Looking at China and Hong Kong, these were the only stock markets that had a really bad year last year. And initially, they started 2022 really good. Hong Kong was up 6-7% in January, but unfortunately China and Hong Kong got crushed significantly in March because Beijing is hesitating to talk against Putin, which is why we've seen a market implosion on March 14 and 15. And only on March 16, the government, even including Xi Jinping, came out to clarify that they want to support Chinese companies listed in America. They want to support the Chinese economy. They want to see a successful Chinese financial market. Only this could turn the market around. And yeah, we can say that ever since this statement, global markets have stabilized materially. If we're looking at high yield bonds on a global basis, they did really well, and they were down less than investment grade bonds. But in Asia, Asian high yield bonds had another bad quarter, very much like last year. But ever since the Beijing government came out March 16, they have also stabilized, and we're expecting that in the coming quarters Asia or Chinese high yield should do better. Tier 1 capital and preferred capital, which tends to display higher yields and shorter duration than investment grade bonds or traditional investment grade bonds, also had a decent quarter vis-a-vis investment grade bonds. They were down also, but just a little bit, only about 2%. And in general, now coming to the beginning of a new quarter, global equity risk premia are about 7% if we look at the FTSE All World Index or the MSCI World Index, which is actually not a bad number. It may be a little bit lower than in the past, but it's not materially lower. And if one assumes an inflation rate that may be more elevated in future, in the past 30 years it was about 2%, then 7% should allow for the maintenance of purchasing power, which is why we're really comfortable if clients are buying into the global equity markets now, even if they're typically more volatile in the short term, especially compared to investment grade bonds. But we're now living in a time where it's important to maintain your purchasing power and deal with higher inflation. Which takes me to a subject which we don't normally discuss with clients, which is commodities. I remember a time in the early 2000s when my employer was talking about putting commodities into every client's portfolio. At that time, there was a lot of talk about a commodity super cycle. But since then, the discussion has died down, and I must admit that many of the products we were looking at the time, they don't even exist anymore. But things may be different now. We've done an analysis and we looked at how global financial markets did in the 70s and in the 80s. And it clearly shows that commodities did significantly better than bonds, but also better than stocks. Although I'm a bit hesitant and I think we can just build quality portfolios with stocks and bonds, I don't know the future. And if the coming years are anything close to the 70s, I cannot not talk about commodities. And I've therefore decided to include two high quality commodity building blocks in our advisory universe. The first one is the Wellington Commodity Fund, which I've been monitoring for many, many years. And it's a very good reflection of global commodity markets. It's actively managed at low cost by Wellington. And I'm really, really comfortable with this portfolio. And secondly, there are all kinds of commodity indices. Probably the most popular at the moment is the Bloomberg Barclays Global Commodity Index, which can be purchased as an ETF. But I've compared it to the Bloomberg Enhanced Roll Yield Commodity Index, which is effectively the Bloomberg Commodity Index in a way where it optimizes the quarterly rolling of commodity futures contracts. And naturally, I would always like to opt for the better solution. I've included this index in our advisory universe. If for whatever reason you'd like to discuss other commodity ideas, we're more than happy to do that. But we think that those two building blocks are sufficient to complement equity and bond portfolios. Since commodities have already done very well in the last several months, I would not chase these ideas now. But I could imagine to add maybe 15 to 20% to global stock and global bond portfolios, because that could be a good allocation. I don't think it's necessary, but for everybody who thinks that we're living in a time that's closer to the 70s and the 80s, this person may consider that. And in general, I would say in a time of less inflation, commodities tend to do really badly, returns are low, and volatility is very high. At the same time, in the 80s, they had tremendous performance. Returns were high, volatility was also high, but it was the right thing to do. But let's probably discuss this on a bilateral basis, because each situation is unique and everybody needs to find a solution that works for himself or herself. Now let's talk about the development of our discretionary portfolio building blocks and the build your own portfolio combinations. We've included a lot of these portfolio combinations in the reflections document because we want to inspire our clients and prospects to look at ways on how they could build their portfolio. And the self-built portfolio combinations naturally performed in line with the performance of the individual building blocks. So that means if you combine these broadly diversified equity building blocks linked to MSCI World or FTSE All World, you did comparatively well. You were down only about 4%. At the same time, if you opted for the portfolio combinations with the active building blocks, especially the portfolio K, which I've been highlighting repeatedly, which includes 6 actively managed portfolios by high quality managers, which is Walter Scott of Scotland, Threadneedle Global Focus, Threadneedle Global Smaller Companies, Goldman Sachs Emerging Markets, Wellington Global Quality Growth, and last not least Fundsmith. These are wonderful portfolios, and the combination of these 6 managers has massively outperformed the MSCI World in the past 20 years. But unfortunately in this quarter it did rather badly. But I'd like to stay the course. Whoever has been looking at these portfolios, now is a good time to invest, because in the long run there are a lot of arguments for quality stock picking. Obviously, whoever doesn't believe it can just stick with the indices, because we're really agnostic. We want to help our clients to find the best possible portfolio for them. But it's worked in the past, so why should it not work in the future? And now may be a good time. Whilst these actively managed portfolios and the individual components were struggling in the first quarter, our so-called dimensional discretionary portfolios did really, really well. And the reason for that is the fact that they're so globally diversified. They contain so many individual securities, and at the same time they have a value tilt. That means they overweight stocks that are comparatively cheap, which benefit from rising interest rates, which is something we can't say about these active managers I just mentioned. And therefore, they're actually a perfect solution for the current environment. We have a lot of clients who own these and are very happy with them. This is why I'd like to talk more about it, because I think they could be a solution that works very well for the current environment. They're easy to execute, they're very low cost, and they do work. And if indeed we live in a time where value is coming back, these portfolios are a perfect fit. So what is the outlook for the next quarter? Markets have significantly calmed down since mid-March, especially after Beijing came out with this very strong statement, which was much appreciated by global financial markets. These were important signals, even if they still don't openly criticize Putin. Wars, has to be said, only affect financial markets in the short term. What is much more important at this point in time is the inflation discussion. At the same time, it's related to the war. The longer this war lasts, the longer inflation will stay elevated, the longer we will see rising interest rates, and the higher the risk will be of potentially a recession in the US. US bond markets have probably anticipated a lot of Fed fund rate hikes, although that may continue, but it looks like a lot has already been adjusted, because interest rates between 2 to 3% may be enough to accommodate a slightly elevated inflation rate. At the same time, European inflation is not much lower than US inflation, but European bond prices are still much lower. So we're quite concerned that there may be more losses for bond investors in Europe, and we would advise against taking significant positions there. Equities overall are comparatively attractively valued. We're looking at about 7% risk premium on the globally diversified indices, which is quite normal. There were times when they were cheaper, but there were also times when they were more expensive. So we don't think there's a reason for them to fall unless inflation were really to shoot up again. Bond prices would have to go much higher, but that's not what the global bond markets are currently telling us. But 2022 may really prove to be a transitional year. So instead of going higher, markets may go sideways. That may be sideways with a downward tilt, sideways with an upward tilt. But fundamentally, we can say that our asset allocation concepts are working. So we really don't have to worry. It's important to adjust portfolios for an investor's personal circumstances, for the cash flows, for the time horizons. But given the inflation situation, there may probably have to be a tilt to equities, and it may be necessary to include a little bit of commodity allocation. The pure safety components, that means the investment components that only invest in investment grade bonds, should only be purchased to the degree that they're needed for the various time horizons and for cash flow needs. Naturally, they have a lower volatility, so we cannot ignore them altogether, but we have to be mindful in how we're using them. For the long-term investment plans, we certainly have to invest in quality equities. It's also important to be in the market. I know some clients are thinking that, why did we not sell? We should have sold everything at the end of the year and now go back into the market. But traditionally that doesn't really work. Markets move very fast. We could see that in China and Hong Kong between March 14 and 16. Yes, on the way down, it's very, very good if you can jump into the market, but I didn't see a lot of people who wanted to do that. Very few clients called us on that day to buy. At the same time, markets recovered so quickly on the 16th, it would have been really, really difficult to then jump into the market. So it's important to be in the market overall. And I think what's quite comforting is that equity investors tend to be aligned with, let's say, the powerful people in this world and the wealthy people in the world, because they tend to own equities, they tend to own real assets, and they want them protected. And that's probably also why the Chinese government blinked. I'm sure they don't like what America is doing, but they also see that America is still controlling the dollar and is still controlling a big part of the global economy, and China just can't do without it. So please adjust your portfolios only if your circumstances change, not because you've been reading the news, because you're scared. If you're scared, call us. We're always here. We're always happy to discuss rationally, because we're basically here to help. If you have fresh funds to invest, I would like to suggest the following ideas aligned with our fair horizon concept. If you need the money latest after 2 years, I suggest you choose the building blocks purple 1 to purple 5, because they've probably already adjusted with higher US interest rates. So we don't foresee too many price adjustments in the coming quarters. If you need the money latest after 4 years, we suggest looking at the Dimensional Portfolio 2, which contains about 20% equities. The rest would be investment grade bonds, short-term investment grade bonds. Or you could just combine the portfolios purple 1 to purple 5 with a globally diversified equity building block such as O1 in a ratio of 80 to 20. If you don't need the money for about 7 years, you could look at the Dimensional Portfolio 3, or a combination of the building block B1, which is basically the Barclays Global Aggregate Portfolio, in combination with O1 to O5, which are the globally diversified equity solutions in a ratio of 60 to 40. That means 60% bonds, 40% stocks. If you don't need the money for about 10 years, we'd be looking at the Dimensional Portfolio 4, or we'd be looking at combining the bond building blocks B1 to B5 together with the equity building blocks O1 to O5. This time a ratio of 40 to 60%. That means more stocks than bonds. And if you really don't need the money for more than 10 years, you could be looking at the Dimensional Portfolios 5 or 6, which have either 100% global equities or 80% global equities, or which, as you know by now, I like active management also, not just indexing. Just look at our portfolio K, buy those 6 active managers, weighted equally, and see whether they can continue to outperform the global indices. I think it's worth a try, but it'll take some time. It's worked in the past, so I think it'll work in future. Time will tell. From my perspective, the current situation is a little bit frustrating, because I like to see my clients make money. I like them happy. I like them smile. Unfortunately, that wasn't what we received in the first quarter, but I know bad quarters are followed by better quarters. in the long run, global equity markets tend to reward us. High quality bonds tend to stabilize global equity portfolios. So I'm not too worried. Even if 2022 may really just be a transitional year, a year where we have to be a bit patient, I don't think it's going to be too bad. And don't forget, we're always by your side. You can always reach out to us. We're more than happy to discuss every detail that you need to discuss. But most of all, I hope we will see peace in Ukraine very, very soon. The people in Ukraine need it. The world needs it. With that in mind, I wish you all the best for the coming quarter.